Today, we talk about explosive findings relating to the mortgage industry. Hello again, I'm Martin North, the Principal of Digital Finance Analytics. Well, it's been quite an amazing day today, with significant more insight coming from a number of sources relating to the mortgage industry in Australia, and boy, is it pretty damning. So first, the ACCC released their draft report on mortgage pricing, and what they've discovered is if you hold a mortgage and you've held it for perhaps a year or 18 months, the chances is that the rates you're getting on your mortgage is not as good as it would be if you went and refinanced today. So there is no bonus for loyalty in the mortgage industry at the moment. And it seems that what banks do is offer attractor rates to grab new business, but then the legacy rates essentially just rise. And of course what happened last year was that the banks applied across the board rate rises on the back of changes in the regulatory framework, particularly around interest only and investment mortgages. And they applied that across the board to all existing mortgages on the book, to varying degrees. And then what they've started to do recently is savagely offer discounts to new business. But what it means is, if you've got an older mortgage, you're paying more than you should. The other thing that the ACCC found was that the plain vanilla type of mortgages, the no frills offers, are actually more expensive than some of the other mortgages out there. So there is a whole load of deception with regard to mortgage pricing. And the banks appear to be complicit in this. The final version of the ACCC report will come out later in the year, but I don't think it will change the tenor of much from what we've seen today. The second thing that we need to talk about is the ongoing Royal Commission into financial services misconduct. And yesterday we heard about referrers who are effectively paid significant commissions just to offer a name to a bank who then actually goes and writes a mortgage. And the whole conduct around that is so concerning because it actually sits outside current regulatory controls. Essentially, a referrer is not giving advice, so it doesn't come under the not unsuitable banner. And what that means is that essentially some banks at least have got round the legislation and around the consumer protections by going through the referred channels. And at one stage, NAB had more than 8,000 referrer points through which they were writing business. But the other thing that came out today was CBA's evidence relating specifically to mortgage brokers. And the CBA is known for a long time that if a broker is able to write an interest-only loan, because the principal is not repaid and a broker gets paid a trail commission over the life of the loan, the broker does better. So there is a conflict of interest between what might or might not be best for the consumer and what translates to a better outcome for a mortgage broker. And in the light of this, and in the light of some of the other conversations and the Productivity Commission's recent conversations about mortgage brokers too, we think that this will be a significant potential trigger point about changing the way that mortgage brokers are remunerated. Currently, they get an upfront commission, which is a percentage, typically 0.68%, and then they get a trail over the life of the loan, which could be perhaps 0.2 or 0.3% per annum. And that's paid every year, whether they actually are providing additional services or not. So I think it's very likely that we will end up now with a different remuneration structure for mortgage brokers, and it will probably be fee-based, and it will probably be fixed fee for service. This is much more in line with what's happened in the UK. And this has the potential to change the mortgage industry significantly, because what it means is that mortgage brokers will effectively now have to declare their costs up front so that people understand what they will be paid. The fee will be for the advice or service around the deal. It will be independent potentially of the size of the loan that may be offered. And because brokers may no longer get trails, the economic proposition for a broker also changes. So this is a big deal. And I think that we're going to hear a lot more over the next few days about other poor behaviour across the sector. But already, I think we know enough to hypothesize that the sorts of behaviours that we saw in the USA in 2005 and 2006 before the global financial crisis, about people effectively getting loans they shouldn't have got on fraudulent bases of various sorts and sizes, has been happening in Australia. And that's a concern because we're now hitting the crunch point with regard to the mortgage cycle, with property prices perhaps beginning to slide. And I think the evidence is now building that we have significantly higher risks in the system than the banks or indeed the regulators have been prepared to admit. As a result of that, I think we're moving into very uncertain territory with regard to the way that the mortgage industry is going to evolve, the regulatory frameworks that will be brought into play, and the risks in the system. If you like what you've heard today, please like the post. If you've subscribed, fantastic, I really appreciate it. If you haven't subscribed, please do so to receive future updates. And check back again next time. I'm Martin North from Digital Finance Analytics. Many thanks for taking the time to watch.